Before we jump in today's video, I just want to remind everybody that I'm not a financial advisor. So this video is for educational and entertainment purposes only and should not be taken as financial, investment, or trading advice. All investments involve risk, and you should do your own research or consult with a licensed financial professional before making any investment decisions. Just remember, past performance is not indicative of future results.
Hey everybody, it's Paul here on my channel, Better Call Paul, and today we have a really exciting battle royale as requested by one of my viewers. The exciting thing about this battle is that these are two of Canada's top passive income funds or ETFs. One of them is primarily based on covered call ETFs, and the other one is a closed-end fund. So for those of you who know, you probably have an idea of what I'm talking about. But for those of you who don't, let's jump right into the first website and take a look at the first of our two ETFs for today. All right, guys, so the first one is HDIV. All right, this is the Hamilton Enhanced Canadian Covered Call ETF. It's a great website, so I would highly recommend taking a look at it. There's lots of information here. All right, you can go through all of the highlights. I'll just tell you that HDIV has outperformed the S&P TSX 60 by 3.56% annualized since inception. That's pretty amazing for a fund of funds like this. The fund objective, the fund seeks to provide attractive monthly income and long-term capital appreciation from a diversified, multi-sector portfolio of primarily covered call ETFs focused on Canada. I would have to say that that Hamilton has been quite successful at achieving this fund objectives. All right, let's take a look for those of you who are not familiar with HDIV, just at the underlying holdings, because as I said, it is a fund of funds. So as of March 31st, 2026, you can see it holds all these different ETFs. All right, so we'll start with the first one. You can see here HFIN, which is the Hamilton Enhanced Canadian Financials ETF, makes up 20%. And this one does not use covered calls. So this one you'll get all the upside, which is one of the reasons why HDIV has done so well recently with the Canadian banks doing so well. So then there's also HMAX, which is the Hamilton Canadian Financials Yield Maximizer at 19.3%. So this one would have the Canadian banks, but using covered call ETFs. And then there's EMAX, which is the Energy Yield Maximizer at 18.8%. And this is also doing really well right now. Well, oil companies are doing really well at the moment. AMAX is the Hamilton Gold Producer. So gold's done very well as well. So you can see that these top four ETFs would have done really well in the past year or so. We also have QMAX, which is the Hamilton Technology Yield Maximizer at 13.1%. UMAX, so we have Hamilton Utilities at 10.5%, and this uses covered calls. CDAY, this is the Hamilton Enhanced Canadian Equity Daymax ETF. So I was really happy when they added CDAY into HDIV, and it's currently at 7.9%. CDAY is one of the three Daymax series ETFs, and they added two of them in. HUTS is another utilities ETF, but unlike UMAX, HUTS does not have covered call ETFs, or it doesn't write covered calls, sorry. RMAX, so here you get some REITs. Now, REITs haven't done too well in the past, I would say maybe 4 or 5 years because of interest rates, but you know, everything is cyclical. So there's a point in time where this may start to perform better and add more to the portfolio. And lastly, we have QDAY, which is the other Daymax series that they've put into HDIV, and this is the enhanced technology one. All right, so up against HDIV, we have Canoe from Canoe Financial. We have the EIT Income Fund. And for those of you who don't know, this is one of Canada's largest closed-end funds. It's an income-oriented, actively managed portfolio focused on quality franchises, stable businesses, and long-term sustainable growth. It's diversified across sector and market capitalization. Let's see here. Risk management ensures the best risk reward ideas and conviction levels are appropriately reflected in position weights. They use a bottom-up investment process. There's monthly distributions, and there's an annual redemption feature up to 10% of outstanding units at 95% of NAV. So let's just take a quick look and see here just of the holdings. So what you'll notice the difference between HDIV and EIT is that EIT is just holding stocks, right? It's not a fund of funds, okay? Right here are the top 10 you can see. I also was able to find in the website the top 25. I wasn't able to find all 56 holdings, but I'm sure if you went through all of the holdings and went through HDIV and looked at their holdings, you'd probably find quite a bit of overlap in the holdings. So let's take a look and see a direct comparison of the two. All right, so we have Hamilton on the left, we have Canoe on the right. All right, so HDIV and EIT.UN. HDIV is a fund of funds, whereas right now Canoe is holding 56 stocks. You can see the inception date. HDIV is very, very new compared to Canoe's EIT. So it just came out July 19th of 2021. I believe this was the original covered call fund of funds. And EIT came out August 7th, 1997. So it's been around a long time. So the launch price for HDIV was $16, and for Canoe, it was $25. So the current price, you can see how well HDIV has done, currently at $21.31, whereas EIT has come down since it started. But remember, it's been around a long time, so it's paid out a lot of distributions. If you figure at 10 cents per month, that's $1.20, right, per year. So just in 10 years, it paid out $12 worth of distributions. If you add that onto the $16, now you're at 28. So total return wise, this fund is, I guess, way above what it's showing here, that you might think that it's like lost money over time. All right, assets under management. You can see that Canoe is about 3 times the size of Hamilton's HDIV, but keep in mind this is fairly new compared to EIT.UN, which has been around for almost 30 years now. So, but still, HDIV, both of them are extremely large for Canadian funds at 1.4 and 3.3, almost $3.3 billion. They're both considered to be actively managed. Now, HDIV does write, the underlying holdings does write covered calls up to 50% of the portfolio. When I tried to find out if EIT was using covered calls, it basically said that normally it does not, but it's an option, something they could do from time to time if they thought it would be, ideal at the moment, right? So leverage-wise, HDIV is using typically 25%, and EIT.UN is using between 15 and 25%. Management fees. So for HDIV, there is technically zero management fee, but all underlying ETFs have management fees from 6.65 to 0.85%. Okay, so distribution, this is where there's a big difference if you ask me. And it's not just because HDIV is 18 cents and EIT.UN is currently paying 10 cents. The big difference is that since HDIV launched, it has been able to increase its distribution many times, right? It started at just over 11 cents and it slowly worked its way up to 18 cents. Whereas HDIV, since I've known about it in 2020, has always paid 10 cents. They both pay monthly. Now you can see the yield for HDIV is higher. at 10.3 versus 7.25, and that's because of the distribution increases. Okay, so that's where you're getting a higher yield from HDIV is because of it's increasing its distribution, whereas maybe Canoe is focusing more on share price appreciation and they don't want to increase the distribution. So yield on cost in my portfolio, okay, just to compare, you can see that both HDIV and Canoe have financials, but HDIV has a lot more in financials at 34% versus 12. Energy, it's the opposite. Canoe has 25% versus HDIV's 16%. Healthcare, HDIV is listing it at 0% right now, where Canoe has 10%. Technology, HDIV's at 12.7, and Canoe has information technology at 4.8. Now, HDIV specifically has a gold ETF at 14.7, where Canoe has materials at 7%. Utilities is a big one for HDIV at 13%. Canoe has industrials at 26.8. And then HDIV has REITs at 2.2 and other at 6.9. Whereas Canoe has consumer discretionary and consumer staples at 9.3 and 4.5%. Also, when I was taking a look at these two funds or these two ETFs, HDIV is 80 to 90% Canadian listed, whereas EIT.UN, which is a closed-end fund, is 52% Canadian and 44% US listed, and then the rest is international. So HDIV really is more focused on Canadian than EIT. So EIT does have the benefit of more US listed companies. However, for the last couple of years, Canada has outperformed the US. So that's helped HDIV a lot. All right, let's take a look and see how they've done since the inception of HDIV, which goes back to 2021. You can see that EIT, just in price return, is outperforming HDIV. But then if we add in the dividends, EIT.UN is still 4% ahead of HDIV. But if we put on the DRIP, you can now see that HDIV is slightly ahead, about 5% ahead of EIT.UN. So they've both done exceptionally well in the past 5 years, and HDIV is just slightly beating EIT.UN. And that may be because of a combination of, I guess, their increasing distributions, and also maybe they're a little bit heavier on financials and energy and gold right now. So, all right, guys. So, like I said, I have both of these still. Although I sold all of my EIT.UN in my portfolio because I wanted to be more aggressive. I wanted higher monthly income. I left the shares in my wife's portfolio because she really likes to see her portfolio more in the green. So if you want an asset that's going to appreciate in value, share price, but also pay a small distribution monthly, then EIT.UN may be a perfect option for you, kind of like a base or foundational position in your portfolio. And I know there are people who started buying this in 2020, when it was down $7, $8, and still have a lot of shares today. The thing is that that's a lot of unrealized gains. So you're not getting paid a lot monthly, but you are accumulating a lot of gains. So I guess it depends on where you want your income to come from. Do you want to have those unrealized gains, or do you want to make more on a monthly basis? With HDIV, I held it for a while, and then I sold it for a gain, and I moved the money, I believe at the time, into ENCL. ENCL was down at the time. It had a higher distribution. It was paying 20 or 21% yield at the time. So I made that swap. But since I opened up my margin account, I decided that HDIV would be a perfect ETF to put in my margin account. So I am now growing that position as well. So anyways, guys, let me know what you think of these two ETFs. Are you holding them in your portfolios? I know for sure that some people are, but let me know what your thoughts are. Are you going to keep them? Are you going to sell them? Are you adding to these positions, or is it just something you've had for a long time now and continue to hold them? All right, guys. Hope everybody's having a great weekend. A lot of people have messaged me Happy Easter, so Happy Easter to everyone who celebrates. And I hope you have a great day with family. And until my next video, bye for now.